Did you know that spending just 45 days in Australia could soon make you a tax resident, even if you live overseas the rest of the year? Sounds unbelievable, right? But it's true. Starting in 2026, the Australian government is rolling out the biggest tax residency overhaul in decades, and it's catching thousands of Aussies off guard, especially retirees, gray nomads, digital expats, and long-term travelers. If you're one of them, or planning to be, this could seriously impact your retirement savings, pension income, and even your overseas property. These new rules could mean paying Australian tax on your global income just because you visited family or kept a bank account back home. The worst part? Most people have no idea this is coming. In this video, we're breaking down the 10 biggest legal changes and exactly what you need to do before it's too late. Stay tuned. Number 1. The 45-day rule. Here's the rule that's turning the world of Aussie expats and retirees upside down, the new 45-day rule. Under the incoming residency laws, if you spend just 45 days or more in Australia during a financial year, you could be classified as an Australian tax resident, even if you live and work overseas. That's right. Just a month and a half on home soil could be enough to pull you back into Australia's tax net. This rule is designed to make things simpler, but for ordinary Australians living abroad, it's anything but. In the past, residency was based on a combination of factors: your ties to the country, your intention to stay, and your behavior. But now, 45 days is the new magic number. If you hit it, you'll likely be considered a resident unless you can prove otherwise. Let's say you're a retiree living in Thailand or Spain, enjoying your golden years. You come back for a few weeks to visit family, handle some paperwork, maybe attend a wedding. You think nothing of it. After all, you've been gone most of the year. But under this rule, those short visits could cost you thousands in unexpected tax, especially if you're earning pension income or have overseas investments. The ATO is shifting the burden onto you to prove you're not a resident, and that's where things get tricky. You'll need to maintain solid records, avoid financial and social ties that indicate connection, and plan your visits with military precision. This is not something to ignore. Want to protect your income and stay legally safe? Stick with us. The next section reveals how the government will track your movements and how to avoid falling into the residency trap. Like this video if this shocked you, and hit subscribe for more insights on what's coming next.
Number 2. The Bright Line Test. Another major change shaking up Australia's tax residency laws is the introduction of the Bright Line Test, a straightforward, hard-line rule that's replacing the old flexible approach with something far more rigid. Under this new test, if you spend 183 days or more in Australia in a financial year, you will be automatically classified as a tax resident. No questions asked. No deeper investigations into your personal situation, just numbers. Cold and simple. This might sound reasonable at first glance, but here's where it gets complicated. Under the previous system, your intention played a big role. If you were only back in Australia for a long visit or to deal with family matters, you could argue your case. You had room to explain your circumstances. Now those nuances are gone. Cross the 183-day mark and you're in. Full stop. What's more, this new test is not just about where you live, but how often you're here. Let's say you're a digital nomad based in Bali, but you visit Australia a few times a year for long stretches. Or maybe you're a retiree who comes home every 6 months to check in on property or loved ones. If your total time in the country crosses that 183-day line, even accidentally, the ATO won't care where your main home is. You're back on their books. And it's not just about residency for that 1 year. Once you're deemed a resident, it becomes harder to break that status in following years. Your global income, offshore investments, and foreign pensions could all become taxable in Australia. This change creates a high-stakes situation, especially for those who live between countries or move seasonally. Keeping track of your days in the country isn't just important anymore. It's absolutely essential.
Number 3. Overseas income now taxable. One of the most alarming aspects of the new 2026 tax residency laws is how they will affect overseas income. If you're deemed an Australian tax resident under the new rules, whether through the 45-day rule, the 183-day test, or other residency factors, then your entire global income becomes subject to Australian tax. That includes foreign pensions, rental income, business profits, interest, dividends, and capital gains earned outside Australia. Let's put this into perspective. Imagine you've retired in Portugal and are drawing a private pension from the UK, receiving rental income from a property in Spain, and earning dividends from US stocks. Under the current system, if you're classified as a non-resident, none of that income is taxable in Australia. But if you fall into the new residency definition, even unintentionally, suddenly all of it must be declared on your Australian tax return. The danger here is double taxation. While Australia has tax treaties with many countries to avoid this, not all income is covered, and the process to claim credits can be complicated and frustrating. Worse still, countries without tax treaties could tax the same income, meaning you could be paying tax twice on the same dollar. This change hits hardest for expats and retirees who structured their financial lives under the old assumptions, people who deliberately moved assets overseas, set up foreign pensions, or invested internationally thinking they were safe from the Australian tax system. Now, that safety net is rapidly disappearing. The ATO's new approach doesn't just look at where your money is earned, it looks at you and where you're considered connected. And if you're even loosely tied to Australia, those foreign earnings could come under scrutiny, dragging you into a complex and costly tax situation.
Number 4. Superannuation risks for expats. Superannuation is often seen as a safe and tax-effective way to fund retirement, especially for Australians who plan to live overseas. But under the upcoming 2026 tax residency changes, your super may no longer be as secure as you think, especially if you're living abroad but still considered a resident for tax purposes. Currently, superannuation withdrawals for individuals over a certain age are generally tax-free in Australia. However, this tax-free status is only guaranteed if you're a non-resident and your residency status is clearly defined. Under the new rules, even if you're living overseas full-time, you might still be classified as a tax resident, particularly if you spend more than 45 days in Australia or maintain ties such as property or family. And here's where it gets tricky. If you're considered a resident, your overseas pension or retirement fund might also come under scrutiny, and your superannuation withdrawals could potentially be taxed, especially if you're transferring funds internationally or using them in countries that don't have clear tax agreements with Australia. Additionally, the ATO may start reviewing how and when super is accessed, especially for those drawing down funds while based abroad. This could mean unexpected withholding taxes, compliance headaches, or even disputes over where your super funds are being used and reported. For expats relying on super as a stable, tax-friendly income source, this change could throw a serious wrench in retirement planning. Even more concerning, many Australians overseas aren't even aware that their residency status directly affects their super tax treatment. If you've built your financial future around your super fund and you're planning to retire overseas, these changes demand your attention. The rules are shifting, and your income security could be caught in the crossfire.
Number 5. Capital gains tax, CGT, for property owners. If you're an Australian citizen living abroad and you own property, either in Australia or overseas, the upcoming 2026 tax residency changes could create some serious capital gains tax, CGT, surprises. Under the current laws, non-residents already face higher CGT rates when selling Australian property. But with the new residency rules, more Australians living overseas could once again be classified as residents, pulling not only their local but also foreign assets into the CGT net. Here's how it works. If you're deemed an Australian tax resident, even temporarily, you may be required to pay CGT on foreign property sales. That includes homes, holiday apartments, and even investment properties located outside Australia. Imagine selling a villa in Italy or a condo in Thailand, only to find out that the ATO now wants a share of the profit simply because you spent a few extra days in Australia that year. This is particularly dangerous for retirees or expats who own property abroad and plan to sell it to fund their lifestyle or relocate. In some cases, people who have lived outside Australia for years could suddenly be hit with a tax bill simply because they visited family or maintained a residential address in Australia. The ATO's focus is no longer just on where your property is located, but on where you are classified as a resident when the sale occurs. If the timing lines up incorrectly, you might be liable for tax, even if you've never rented the property or thought it was outside the ATO's jurisdiction. For property owners with global assets, this change introduces a complex layer of timing, residency status, and reporting obligations that must be carefully managed to avoid costly and unexpected tax hits.
Number 6. Dual tax residency risks. One of the most complicated and financially dangerous outcomes of the 2026 tax residency changes is the risk of becoming a dual tax resident, where two countries both consider you a tax resident at the same time. This isn't just a bureaucratic headache. It can lead to double taxation, missed credits, and serious legal confusion that could drain your income and take years to untangle. Under the new rules, it's far easier for the ATO to classify Australians living abroad as residents, even if their host country already considers them a resident under its own laws. For example, you could be living in Malaysia full-time, paying taxes there, but because you returned to Australia for a couple of months and kept your bank accounts and Medicare card active, the ATO might still treat you as a resident too. Suddenly, both countries want a slice of your income. While Australia does have double tax agreements, DTAs, with many countries, they don't cover everything, and they aren't always clear-cut. Some income types, like pensions, trusts, or capital gains, may not be treated equally across borders. In many cases, you'll have to navigate tiebreaker rules, submit extra documentation, and wait months or even years to reclaim tax credits. The administrative burden alone is massive, and the financial risk is even worse. A simple misstep in travel planning, document filing, or income reporting could mean paying tax twice on the same dollar. For expats, retirees, and global workers, the key risk is that you may not even realize you're in dual residency status until you receive notices or penalties. These upcoming rules create a fragile legal landscape where timing, ties, and transparency are more critical than ever.
Number 7. The factor test. Beneath the surface of the new 2026 tax residency rules lies a subtle but powerful mechanism known as the factor test, a secondary tool the ATO will use to determine whether you're still connected to Australia, even if you don't meet the 183-day threshold. This test examines the personal and economic ties you maintain with Australia, and it can easily tip the scales against you if you're not careful. So, what exactly does the factor test look at? There are 4 key elements: whether your spouse or children are in Australia, whether you own residential property, whether you have an active Australian business or job, and whether you maintain social or financial ties, like super accounts, voting registration, or private health insurance. If 2 or more of these factors are present and you spent more than 45 days in Australia in a year, the ATO may classify you as a tax resident, even if you live the rest of the year overseas. For many retirees, digital nomads, or overseas professionals, this is where things get unexpectedly risky. You might think you've moved on, settled in another country, made a new life, but if you still own a house back home or have family in Australia, the ATO may see that as reason enough to tax you on your global income.
What makes the factor test especially dangerous is its subjectivity. It doesn't rely strictly on numbers like the 183-day rule. Instead, it looks at the quality and nature of your connections to Australia, which makes it harder to challenge or predict. Even a brief return to care for elderly parents or maintain a rental property could unintentionally reset your residency status and bring all your foreign income under Australian tax law.
Number 8. Seniors and pensioners abroad. For many Australian seniors, retiring overseas is a dream. Lower cost of living, better weather, and a more relaxed lifestyle. But under the new 2026 tax residency rules, retiring abroad is about to become a lot more complicated, especially when it comes to pension income and your overall tax obligations. The issue is simple but serious. Even if you've settled into retirement life overseas, the Australian Tax Office may still consider you a resident for tax purposes, depending on how often you return and what personal or financial ties you've kept. This means that foreign pension income from countries like the UK, New Zealand, or even private EU pension plans could become taxable in Australia if you fail the residency tests. Many retirees have carefully structured their lives to avoid this, shifting assets overseas, closing old accounts, or relying on foreign pensions to stretch their savings. But if you make the mistake of visiting Australia for more than 45 days in a year, or if you still hold property, an active Medicare card, or even maintain your voter registration, the ATO might still classify you as a resident. That decision could trigger a tax bill on income you thought was protected, turning your peaceful retirement into a bureaucratic nightmare. Even worse, some countries don't have strong tax treaties with Australia, meaning there may be no protection against double taxation, where both countries claim rights to tax the same income. This could reduce your retirement income significantly and disrupt your financial plans. For seniors planning to spend their later years abroad, understanding how residency status affects age pension eligibility, super withdrawals, and foreign pensions is now absolutely essential. One wrong assumption could lead to years of back taxes and penalties.
Number 9. Trusts and family businesses. If you're an Australian living overseas and have any involvement with a family trust or small business back home, the upcoming 2026 residency laws could significantly increase your tax exposure, and not just in Australia. These rules are tightening how the Australian Tax Office assesses ownership, control, and distribution of income from trusts and businesses, especially when you're still seen as having ties to the country. Under the new tax residency framework, if you're classified as a resident, even briefly, you could be required to report and pay tax on income distributed to you from a trust, regardless of where that income was generated. So if your family runs a business in Australia and you're receiving income through a discretionary trust, that money could now be fully taxable in Australia, even if you're living in Singapore, Dubai, or London. Worse still, if you're involved in decision-making, management, or even if you're listed as a beneficiary, your overseas residency might not be enough to shield you from the ATO's reach. The government is cracking down on individuals who, while physically outside the country, still influence or benefit from assets held in Australia, and trusts are a major focus. Even more alarming, foreign trusts with Australian beneficiaries or controllers may also be impacted. If you're drawing income from a foreign family trust while still having legal or financial ties to Australia, the ATO may attempt to tax that income under residency rules, especially if you're found to have economic control. This creates a serious compliance burden for Australians abroad. Without careful planning, simple family arrangements that once avoided tax complications could suddenly trigger complex audits, reporting obligations, and large tax liabilities, simply because the definition of residency has changed. Number 10. The exit strategy. With all the changes coming in 2026, one thing is becoming very clear. If you want to live overseas and avoid being taxed in Australia, you need a proper exit strategy. And it has to be more than just booking a one-way flight. The new residency rules don't just look at where you physically are. They focus on your financial footprint, your social ties, and even the intentions behind your actions. Many Australians living abroad assume that simply living outside the country makes them a non-resident. But under the new laws, You could still be considered a tax resident if you own property, maintain bank accounts, hold private health insurance, or even keep a Medicare card active. These are seen as indicators that you haven't truly cut ties, and that gives the ATO grounds to tax your worldwide income. To avoid falling into this trap, a proper exit strategy means more than just relocation. It could involve selling or renting out your Australian home, closing unnecessary local bank accounts, deregistering for Medicare, removing your name from electoral rolls, and legally restructuring your business or trust involvement. These actions help demonstrate that you no longer have sufficient ties to be classified as a resident. Timing also matters. If you're planning to sell foreign assets, withdraw from super, or restructure your income, you'll want to do it after you've clearly broken residency, not while the ATO still considers you connected. Any income earned while you're technically still a resident could be taxable in full, even if you've already left the country. Ultimately, the 2026 tax residency changes are forcing Australians abroad to be much more strategic. Without a clear and deliberate exit plan, you might find yourself trapped in a tax system you thought you'd left behind and paying dearly for the oversight. The 2026 tax residency changes aren't just small tweaks to existing rules. They represent a major shift in how the Australian government defines and tracks your financial identity, especially if you're living or planning to live overseas. For expats, retirees, digital nomads, and even short-term travelers, these laws could turn an ordinary visit home into a financially devastating event. What makes these changes so concerning is how easily and quietly you can slip back into Australian tax residency without even realizing it. Just 45 days in the country, owning a house you haven't sold yet, keeping your Medicare card just in case. These everyday decisions, once harmless, can now trigger full tax residency status, exposing your global income, pensions, super withdrawals, and overseas assets to Australian tax. The rules are changing because the ATO wants more certainty and control. But that certainty for them creates uncertainty for you. And while these laws are being framed as simplifications, the truth is they create new layers of complexity, especially for those with international lifestyles or cross-border finances. If you've built your life overseas or plan to retire abroad, you now need to think ahead, not just about where you live, but how to legally disconnect from the Australian tax system if that's your goal. This might involve restructuring your finances, changing your travel habits, or getting professional tax advice to navigate your new obligations. What's clear is this: doing nothing is no longer an option. Whether you leave Australia for a few years or for good, the choices you make today could protect you from thousands or even tens of thousands of dollars in unexpected tax bills tomorrow. The time to act is now, before these laws come into force.